Enterprise value, that's the value of the entire firm, the equity, the debt, everything else. And I'm going to standardize that by what's in the bottom down there, the sales number. Sales is at the top of the income statement. It's available to all of the firm's investors. Enterprise value to EBIT, same idea. Enterprise value to EBITDA, all I'm doing is putting back in depreciation, which is what we call non-cash expense, putting that back into the bottom of the fraction there in the financial statistic. So there's consistency with respect to the value measure and who gets that value. So oftentimes firms will say, we're trading at some multiple of EBITDA. Alternatively, we can look at equity value multiples, and what we see here is like the price per share, which is stock price, equity holders, and we're standardizing that by a financial statistic that flows to the equity holders. It comes out of the bottom of the income statement. So we have to have consistency with those. So if you're ever looking at multiples, that's the first check that you want to try to make if you ever have to look at these. And so here's an example, and I just pulled a company to kind of illustrate how we get into this. This was an analysis of Heinz Corporation. So if you recall last year, Heinz was taken private by a consortium of private equity folks, Warren Buffett leading the charge with that. And so what I pulled just randomly was a set of comparable firms for Heinz. And this was a set of comparable firms that was generated by Capital IQ. And I didn't put a lot of thought into whether they're good comparables or bad comparables. I just put them up there to kind of illustrate how this works. And what you see are the multiples. This is the enterprise value to last 12 months revenue, last 12 months EBITDA, last 12 months EBIT. So consistency in those multiples. But what's interesting is if I just base my company on multiples, the spread of these trading multiples is pretty great. So the low value here is 0.2 times revenue, and the high value is 3.2 times revenue. It's a huge spread in implied value as a result, right? So if you're trying to impute the value of a private company based on some of these numbers, you really don't have any way until you start to look into the fundamentals, and that's the next thing we're going to talk about, as to whether or not you're at the low end of that range or the high end of that range. People quote averages, and it's hard to say whether or not you're at the average. So that's one of the pitfalls of relative valuation. And so how do we use that? We take those multiples then, and we look at the company's income statement, the EBITDA numbers, and then we back out an enterprise value based on those multiples. And then if you think back to that equation that I gave you, we subtract out the debt, the equity, and the minority interest, and what we have down here would be some implied equity value. And we can do that across several different multiples. So that's sort of how the process works when we look at comparable firms. Comparable transactions works exactly the same way. Instead of looking at how firms are traded, what we're looking at is the prices at which firms have sold in the past, in recent history. But again, we have the same consistency in the multiples. So we have some enterprise value, it's also called transaction value, and we standardize that by financial statistics that are going to go to all of the firm's investors. Alternatively, we can look at an equity offer, or the equity value or the offer value per share, but we have to standardize those by equity financial statistics. But same process here. This was a sampling of transactions in Heinz's sector that stretches back from, what are my dates here? 2010. I think I went back like 3 or 4 years with this, maybe 5 years on my screen. And what was generated then were the implied multiples based on those transactions that were completed. And again, you see a lot of variance in the multiples. So the low is 0.2 and the high is 4.1 times sales. A huge spread in implied value as a result. It gets worse when we look at implied enterprise value to EBITDA. It goes from 8.2% to 18.4%, and then the EBIT 9.8 times to 22.4 times. So a lot of spread, and what that does, it results in a big spread of implied enterprise value and consequently implied equity value. So you have to be really careful, and these multiples are very sensitive to the time I look at over the transactions that I look at, how comparable they are, the means of compensation in the transaction. So lots of variables can throw those numbers off. So blindly applying multiples is not always a good strategy. Just a few tips on what to look for when you're looking at multiples. I mentioned this one. Make sure that we have some consistency in the multiples. Define the multiples. Make sure that they're defined similarly. Different companies will define, they'll define their financial statistics slightly differently, possibly. Oftentimes, when I look at prices at which companies are trading at, I'll look at the distribution of EV to EBITDA or EV to sales, just to see how those multiples are distributed. If you don't look at the cross-sectional distribution of how these multiples are distributing, then it's really hard to say whether a particular company is trading high or low. So it's a good idea to look at the cross-sectional distribution. And I'm a big fundamental person when it comes to valuation. So we want to see what are the fundamentals that drive that multiple. So what are the items in the income statement that give rise to the particular EBITDA that we're looking at, and I'm going to talk about that a little bit at the end, and how we manage value. And then we can apply the multiple. Questions, is the multiple consistently defined? Make sure that we have that consistency between the value statistic and the financial statistic. And is it uniformly estimated? Are we looking at the same inputs to the multiple across our comp set? The flip side of value, the other prong of valuation, is what we call intrinsic valuation. And the idea with intrinsic valuation is, at the end of the day, we say, what is the value? Basic corporate finance question that I ask students is, how do we find the value of any asset? The value of any asset at the end of the day is the present value of the expected future cash flows. And so intrinsic valuation tries to get at that relationship to see what is the value of the cash flows that the company's generating. This is a little graphic that kind of walks us through the basic DCF type model. What we see in the top part of the fraction here are what we call free cash flows, and those are cash flows that go to all of the firm's investors, as opposed to like net income or some other equity multiple. These would be cash flows that go to all of the firm's different investors. And how do we calculate that? We look at this EBIT number. It's driven by EBIT. Remember where that's at in the income statement. We add back our non-cash expenses, depreciation and amortization. And then we take out some investment in working capital and capital expenditures, and that's what gives us the free cash flow number. On the bottom, whenever we do this type of valuation, we always want to make sure that we have a discount rate that matches the riskiness of the cash flows. So since I have a measure that goes to all of the firm's investors, I need a discount rate that reflects the required return to all of the firm's investors. And we call that the weighted average cost of capital. It's got some blend of debt and equity costs, and they're weighted by the proportion that companies contribute to the firm's capital structure. So this is the general model. The weighted average cost of capital, I want to talk a little bit about this. What is this number? The RE is the required return to the equity investors, and RD is the required return to the debt investors. We look at the after-tax cost of debt because that interest comes out of the income statement, and so we want to make sure that we account for that essentially tax benefit associated with debt. And then the weights are the proportion of debt or the proportion of equity in the firm's capital structure. Just a couple points when estimating the weighted average cost of capital, estimating the discount rate. We want to try to the best of our ability to use market rates for the debt and the equity. Debt, you can kind of maybe take a little bit of a pass because the market value and the book value is usually pretty close on debt. Equity, not the case. So if you look at the balance sheet of a company, the equity number is often much lower than what the market value of the equity is. So we have to try to estimate the market values of those, not the book values. In theory, the weighted average cost of capital is supposed to be a forward-looking number, so it should be, in theory, the number that, the discount rate that will apply over the life of the cash flow stream. But this is where we run into reality, and we don't have a crystal ball. We don't know what that forward-looking number is. So really the best thing we can ask is, what would it cost the firm to issue debt or issue equity today? That's about the best you can get. So a couple points on that. Just how do we go about estimating some of these inputs? For those that have some finance background, you may remember that the cost of equity is estimated typically through some version of what we call the capital asset pricing model, and it's a function of some risk-free rate that we use as an estimate of the risk-free rate. We tend to use the U.S. Treasury bond for domestic firms. This beta coefficient, which is a risk measure that looks at the relationship between the firm and the market, and then the spread, they call this the equity risk premium, which is the spread of the return on the market less the risk-free rate, so that spread. So all of these require inputs, and all of these inputs are perfect, so valuation is not an exact science. Debt costs, if the firm has public debt outstanding, we can back out some implied equity cost, some implied debt costs rather. We can also see quotes from debt underwriters. That's probably a pretty good way to figure out what it's going to cost me to issue debt today. So that's some of the technical stuff associated with the weighted average cost of capital. The model that I showed up here is, if you look at this series of cash flows, one of the assumptions that we make when we value firms is that the firm is going to go on in perpetuity. And so you see here, we express that with that little infinite symbol. So in theory, what we're trying to do is sum the present value of the cash flows from like today out to infinity. Well, we can't do that, obviously. So we need some trick to try to capture the value of the cash flows from the end of some reasonable estimation period out to infinity. And we call that the terminal value, and so we build that into our models when we do discounted cash flow valuation. So the terminal value captures the value of the cash flows that the firm will generate after the estimation period ends. So typical estimation period is about 5 years. If you look at discounted cash flow valuations, it's about 5 years. In theory, it should be, you should estimate the cash flows out long enough to the point where the firm reaches some steady growth state. So, but 5 years is the convention, give or take. A couple ways that we can estimate this terminal value. One is a discounted cash flow approach. And so we take the cash flow at the next estimate, one period after the estimation ends, and we divide it by the difference between the weighted average cost of capital and some growth rate that we expect the firm to grow at in perpetuity. So somebody was asking me this morning, well, how can I overstate the value of a firm, private firm? It's real simple. I can manipulate this spread right here. So if I have a bigger spread on the bottom, that reduces that discount rate. It makes this fraction bigger, and when I discount it back to present time, I have a bigger present value. So there's a lot of debate about what's the proper growth rate, right? I can make an assumption and say that I expect the firm to grow at inflation in perpetuity, 2%, right? Somebody can say, well, there's got to be some real growth attached to that, so maybe it's going to grow 4% in perpetuity. So there's lots of ways that you can trick these models into getting where you want to go. Ideally, if you have somebody doing valuation work for you, you want to have somebody that's going to make reasonable assessments on what these inputs are, and that's really the important thing there. Alternatively, we can estimate this terminal value by using some multiple methods. So we look at some multiple of sales or some multiple of EBITDA in the last year of the estimation. So, and again, what multiple do I use? Well, this terminal value actually is a very big value driver for the valuation. So, there's a lot of room for manipulation, I guess, is the best way to put it. So I'm going to just walk you through a little example discounted cash flow analysis that I put together for Heights. So what I have here, we need the historical data to help us predict what's going to happen in the future. This is the historical data. This is the projected values going forward. For some of the relationships, EBITDA as a percentage of sales, depreciation and amortization as some percentage of sales, etc. My weighted average cost of capital estimate that I put together, and then my terminal value estimate. And I did it two ways. I have the weighted average cost of capital method that I showed you, and also the terminal value method. And if I had the Excel spreadsheet up here, I could show you the difference. If you look at the, so Heights sold for $27 billion roughly. The terminal value number that I have for using the weighted average cost of capital method is about $26 billion at the end of the estimation period. Alternatively, if I look at some multiple of the last year EBITDA and the last year of my projection, it's about $22 billion. So that's like about a $4 billion difference, like that, right? So really can be very, very touchy. Using the, I used, in the numbers I'm showing you, I used the weighted average cost of capital method for my estimate of terminal value. So those are my inputs. This is what the model looks like as I project it forward. And what you see down here is the unlevered free cash flows, the free cash flows that are available. I'm going to discount those at my weighted average cost of capital, and I arrive at an enterprise value of about $24.5 billion, $24.5 billion. Kind of squares up with what they paid for the company. They paid $27 billion for it. So where is that $3 billion? Maybe it's in synergies that I don't have captured in my model. But since I really don't know, I'll show you what we do to, like, this is called CYA. I'll show you how we do that in a second here. This is my estimate of the weighted average cost of capital. I've got the cost of debt that I took from the bonds that were issued to Warren Buffett and his group to take the company private. So I just used that. Interest rate was the most contemporaneous number I had. This beta coefficient, you can get this from a lot of different sources. Yahoo Finance, Google Finance, they all provide beta estimates. They're all different, by the way, and if you want to talk about why that's the case, I'll be glad to tell you. And then what you see here is the capitalization of the firm. So at the time that the firm was taken private, it was 82% equity finance and about 18% debt finance. And the weighted average cost of capital, again, that I used was 5.64%. So what do we do? I've got this number up here of $24 billion. I do this. I give you a range of values. So this is my best guess estimate of what the company is worth. By the way, I looked at this about 50 times. If I look at my number here, 24.5, and then I look at my number here, it should be the same, but Excel did some rounding thing, and so they picked up a couple $100 million in a rounding here. So if you ever look at how equity prices are quoted, you're never going to see an analyst say that, I think that the value of this thing is worth $25 billion. You're going to say somewhere between this and this. And in this case, my estimate is somewhere between about $22 billion and about $29 billion. So I'm right in the sweet spot of what Warren Buffett ended up paying for it. And how sensitive is that? Here is a terminal value growth rate. I use 2%. If I jack it up by 0.25%, you can see that it changes the value by about $2 billion, right? So very sensitive to very small changes in the inputs. So that's my discounted cash flow model. Now, what do we do with private firms? Everything gets different when we deal with private firms because we don't have good comparable private firms oftentimes, and there are lots of wrinkles. But this basic idea of the process is going to be important. So when we look at private firms, the first thing we want to ask is this firm an ongoing concern? And that makes a big difference in how we value the firm. So two big questions that, if you're sitting back thinking, do I have an ongoing concern? The first one is, do the customers and other stakeholders see themselves as dealing with the business owner or the business or the current owner, right? So can you separate out the owner-manager from the operation? Second one, and similar, is could the firm continue to operate as it's currently structured, and that's an important caveat, as it's currently structured if the current owner-manager is replaced. So if I take the owner out, does the firm still go on? If the answer is no to those questions, then you do not have an ongoing concern. So if we do not have an ongoing concern, how do we value the company? Essentially, when you have a a situation where an owner has essentially created a job for themselves, that's kind of what we're talking about. All we have is a collection of assets at the end of the day. And so we're going to try to value those assets. And the theory is that some other buyer of the firm, of these types of non-ongoing concern firms, some potential buyer is going to take those assets and do something, either similar or different with them, make changes to the operation, etc. So we just look at it as a collection of assets, and some of the big assets that we're going to look at are accounts receivable, inventories, and fixed assets. And then there's some intangibles I'm going to talk about in a minute. Some things that we want to think about when we're valuing the receivables. Does the sale include the receivables? And this kind of depends on the type of business that you're looking at. How much control does the business have over the product that it sells? For example, if you have a straight retail type operation, it's probably okay to sell the receivables along with the business when the business is going to transfer. But if you have a business that does some specialty manufacturing, it may not be worth selling the receivables because there's some liability issues, product liability, implied warranties associated with those products that went out the door before the new owners come. They may pose more of a liability to the new owner than they're worth. So it's that's a case-by-case basis. And then what's the quality of the receivables? How are they aged out, etc. So I think John can probably talk more about that than me. Inventories. We want to ask: Will the buyer operate a similar business, or are they going to do something different, or are we just going to liquidate the inventory? That's a possibility as well too. And then the assets, how specialized are the fixed assets? Are they unique and idiosyncratic to this particular company, or are they something that can be sold on the market to other would-be